Good afternoon, this is Ken Long from Tortoise Capital, and I want to review some chat room examples of 3 of the 4 ways of knowing that we use in action research to describe the ways adults learn from experience and from reflection and from study. Experiential knowledge is that knowledge that we generate from the direct experience in the moment as being part of the action while it's happening. Presentational knowledge, that form of knowledge that we learn as we tell our story, that the act of telling the story, creating the narrative, engaging in communication, creates pathways to knowledge and types of knowledge that are encoded only when conducting narrative. Propositional knowledge is what we think of traditionally as a scientific method that arises from formal study through research and reflection. And then practical knowledge we would think of as that knowledge which is accessible for effective routine application after we've gone through a period of study and practice that's immediately available to us and is able to be put into action. And so we're going to talk about experiential, presentational, and practical knowledge in these chat room examples that come from the first couple of weeks of January 2014 in the Tortoise Mastermind chat room. And these are all participant live trades that we're being engaged in live in the market and I talked about in the chat room. And we're going to see them as examples of practical knowledge in action, both through the act of trading, recording of the trading, reflecting on it, sharing it with others, talking it through in the chat room, and then having them available as case studies in our live trading journal or the closed trade journal in the chat room so that we can share our knowledge and make use of these different modes and methods of generating knowledge. This is typical of the chart markups that we'll be seeing, so I'll spend just a little bit of time talking about these. You'll see that the shaded blue area in the middle is what we call the river, the 30-period Bollinger Band plus or minus 1. 2/3 of the price data of the previous 30 time frames are located between the north and south edge of that river. And this red line in the middle is the 30-period simple moving average, or the exact middle of the Bollinger Band or the middle of the river. The lighter blue shaded area, in this case marked off by dotted red lines in this trader's version, is the 30-period Bollinger Band plus or minus 2, and we think of that as the floodplain. Occasionally the river will overflow its banks and stretch that far, and then that represents 95% of the previous 30 periods price action. Only 5% has varied outside of that. This is the phenomenon here of the Bollinger Band pinch when things come together. The shaded red area you'll see is, we call that the dragon. It is a 10-period Bollinger Band plus or minus 0.5, and we think of that as a early indicator of change in the direction of the river. In this case, you'll see the dragon went down and then back up, and then that was in front of the river, which slowly turned, found a narrows, and then started to go back up. So we use that as a guide against noise. It informs where we're going to place stops and so forth. We call it the dragon. We think of it as the Chinese dragon spirit that lives in the river. 30-period regression line, the moving regression line, is this black line, and that is simply the adjusted slope of the 30-period regression line at each moment. And then the 10-period moving regression line is the blue. And so when they cross over outside the river, we have a regression line crossover strategy or signal, and then this trader has marked that off by a green circle, and that's the moment of his entry at the green line. A second entry here. An exit is usually indicated by red circles, and the red line is where the trader was managing his stops, and you can see the relationship initially to the 30 period, and then picks up the dragon, and the far side of the dragon all the way through. My markups as a trading coach, if you will, are the blue circle and arrow, and then text that's inside the shaded red box. And so the trader was trading TNA, which is a triple leverage Russell on a 3-minute chart. His entry was at 75.22 with a 30-cent stop. he took an exit at 75.60 on one half the position, and then took a final exit on the second half of the position at 76.53 for a total of 2.8R out of the entire trade. This is what I called a perfect template or a perfect flashcard to show pattern number one in the regression line crossover, and that is price comes out of the river, the regression lines are out of the river, that's the trending behavior, and now we have a regression line crossover. The first target is the Bollinger Band mean. It held there. We had a sideways quiet channel and a breakout from there. In the blue circle, my coaching point was that in this region of the blue circle is where we, in this strategy, look for re-entry or adding a position if we we're looking to get larger after the success of the first leg up, or beginning a position on sideways quiet channel breakout if you didn't already have a position or had closed a successful trade on this first leg, because this is a pattern number two, the sideways quiet channel. The exit, in my view, was exactly right. What we had was range expansion, large white candles, then the range is beginning to get smaller, price no longer making a new price level. It's hitting what used to be support and now has become resistance. It's made a nice move up, and now you can see the 10-period regression line cross rolling over, and somewhere in the next 1, 2, or 3 time frames, we're going to see that regression line cross over the 30. We'd have an RLCO outside the river on the far side, which is our signal to you have to be out not later than that. So selling into the stalling price action, in my view, is a perfect place to exit that is consistent with this strategy here. And so that's our coaching point on there. But still, 2.8R on that trade off the initial plan is excellent, but we can learn from those by looking for ways to see even more. In the discussion in the chat room, the trader observed that he was so busy thinking about his decision, whether or not he was right to have gotten out, and the emotions associated with the positive trade here, that he didn't recognize the SQC forming. And this is a case where current trade emotions can get in the way of having a direct observation over patterns. So we want to take advantage of coaching points and reflective learning to recognize that in ourselves and to look for ways that we might improve our strategy and refine our technique. Another trader was taking a look at this one, and he was trying to play a sideways, what he thought was a sideways quiet channel or an RLCO in this region, entering at the green circle, looking to go long and retest the swing high, the intraday high, and then ended up getting stopped out here for 1R. And so this turned out to be a really important way to clarify some of the language of the RLCO. The first is that we're going to talk about 3 different strategies. The Anderson regression line stretch, named after Kim Anderson, one of the super traders who has identified one particular pattern in the RLCO that she likes to emphasize for quick hits. And so we call that the ARLS, Anderson regression line stretch, the regression line crossover, and then the SQC pattern, sideways quiet channel. Now they all use this same market framework that I've been describing, and you can see that in this chart here. And so by definitions, the ARLS is a sudden, sharp, strong directional move that takes price far away from the river and creates a noticeable gap between the 30-period regression line and the 10, and normally causes price to end up well outside the floodplain. This circle here demonstrates exactly that kind of a breakout pattern in price, and then creates an extraordinary move away from the Bollinger Band mean and well outside the floodplain, which often features a sharp snapback in the direction of the Bollinger Band mean. The RLCO is after a directional move, price stalls and begins to revert back to the Bollinger Band mean. Now you can see later in this price action, the RLCO occurs inside this blue circle. So price has had a nice run up. Price left the 10 behind, which left the 30 behind, and now they come back together inside this blue circle, and then our target, the price that we're not allowed to be surprised at, is if it comes back to the Bollinger Band mean like it did. Now, sideways quiet channel, the third pattern in this little lesson, is Sideways, we think of as the Bollinger Band mean is flat. Quiet, in that the Bollinger Bands have pinched to become relatively narrow. And channel, so that price and both regression lines are inside the river. That's pretty close to what we have inside this area here. Now the strategies in these three different patterns on the ARLS is to play for a very sharp snapback when price crosses the 10, with the idea that when price gets down to the 30, we would cash it. And we're playing on the divergence between the 10 and the 30. And so in the Kim Anderson play, this sharp spike up is the alert. The entry to go short is here. The exit happens within 5 minutes, and there's a nice quick hit with a stop at the top of the bar. You can see that looks around 1 to 1.5 R. It's a quick hit and run. It happens quickly when it does occur. The regression line crossover strategy suggests that we are entering not later than the price re-entering the river, and using our first target as the Bollinger Band mean, and then with a price target at the far side of the river as the secondary play, with a stop either at the edge of the floodplain or at the resistance point plus a couple pennies. And so in that case, this would be an entry here with a target of 1 and 2R, and then taking it somewhere in here once price fails to fail further. The sideways quiet channel trade occurs in the direction of price breaking out from the channel in either direction, although we prefer going in the direction that the Bollinger Band mean would suggest. In this case, in this sideways quiet channel, what we would be looking for is when price gets out of the river somewhere in this region, or even as late as this entry, getting short because the sideways quiet channel has occurred, the slope of the Bollinger Band mean is downward, and we'd be looking to be short somewhere in this area with the stop on the far side of the river and letting it go as far as we want. So the purpose of this discussion was to help the student, to help the trader understand the conceptual difference between these different patterns and make sure that he was naming things correctly and following through with the correct strategy. In this case, what he was thinking was an Anderson regression line stretch, because price had come out of the floodplain, was actually nothing more than a continuation of the SQC, and that he didn't recognize the conceptual difference between those two. So one of the things that we get with the crosstalk in the chat room is the ability to, through the use of presentational knowledge and reflective learning, to clarify our language, to unpack the assumptions that we're using about our strategies, and making sure that they are locked in. This is a case of a swing trade pattern where, in a very simplified version, without even using the river, but using tortoise-style strategies, the trader looked at GDXJ. The junior gold miners have been ritually abused in 2013, but which had found support levels after what we think of as the washout pattern, and then 2 expansion bars here that allowed him to get long with a third of what he hopes to be his final position, which is going to end up aiming for a reversion to this mean, the long-term mean. And now he's got a third of his intended position on, and he's looking at this as a pullback opportunity to get longer if it holds support here at the moving average. And so he would be looking for ultimately a target back to 42, which wouldn't surprise us, which was the last place that it found resistance, and then it had found resistance here as well. And now he gets his the next day he gets his next position in as the measured pullback finds support at a higher low, so we have something like a double bottom, almost a sideways quiet channel, a breakout, a pullback finds support. Now the mean on this moving average has started to roll back up, and now he's ready to get started on the next leg and possibly adding an additional position. This was an example provided by one of the chat room members in our discussion about the Anderson regression line stretch. Each one of these highlights in TradeStation shows a case where price had made a low well outside the river and the floodplain, followed by a higher low, with the idea of playing a trade to the reversion to the mean. In this case, it happens. In this case, it happens quickly. In this case, it happens very quickly. And so the Anderson regression line stretch alerts us to a significant breakdown under normal conditions that is we think of as probably anomaly, and that when we see the reversion back in towards the river and floodplain, that there's a quick hit that's available. Here is a regression line crossover that happened just outside the river, and an entry here at the edge of the river, and the trader played for, with a 25-cent stop, gets half the position exited here at the Bollinger Band mean. When it starts to fail inside this red candle, taking the entire position would not have been wrong. And then the trade gets to the far side of the river and starts to fail. His exit was slow because it let it come all the way back to the Bollinger Band mean, and so somewhere in this region a reasonable exit could have occurred, because it got as far as we had an expectation that it could occur. Now what I want you to see is that it failed precisely at a level where resistance or where support failed before. And what we're looking to learn how to do better at is illustrated in the following chart markup. So not just looking at this part of the pattern and looking to improve our exit. So that this is a fine trade. Nothing wrong with that. You can make a living doing that. What this one shows is the same trade marked up by regions. And so the previous move up, I've highlighted the positive psychology in the green circles, which then goes to a neutral when it can't make a new high, and then starts to fail back to the Bollinger Band mean, so things getting worse. Finds support at the edge of the river, but now at this critical port here, we see price breaking down from the previous support, which now negates this entire move up and this slow rolling over change in psychology, and this is where we want to be getting short, not later than at the collapse of support, and then the sharp, harsh move down. This actually becomes an Anderson regression line stretch. We can start going long here with the idea of price being targeted at the crossing of the 30, or we can wait for the regression line crossover outside the river with an entry here, and this was now picks up the previous trade that we just saw with the idea of target 1 at the mean, target 2 at the far side of the river, with these explanations. So what we're trying to do is look at the sine wave or the yin-yang wave here and realize how psychology changes with respect to location during the river, and then we can use the river and regression lines as a way to calibrate adaptive to volatility, the different market psychologies. But this breakdown of support is really a key state. When it comes back and tests here, this is either going to find support and then become a lazy W and a continuation up, or if it collapses, a sharp breakdown, and we want to be prepared at a key state to handle either one of those directional trades. This is a description of the gain stat, which is a new indicator we're using, which takes the average move of a symbol from the open to the high of the day, and then uses that to estimate what reasonable intraday moves are. The day we published it and started talking about it, one of the traders made this observation, that in the case of, this looks like SPY and XIV, after the open they gapped up and then had a gain to vicinity, each one's gain stat, the average move from the open to the high of the day, and then began a long downward drift, and you combine that with an RLCO here and here, and you have the opportunity to start getting short and reversing to the mean. So it's surprising when it's not really surprising when things behave the way they normally behave. So we're using that to improve our ideas and on the intraday trade. This one is a trade in UPRO, which is a leveraged Dow 30, and you recognize this pattern already. Collapse of support, find support RLCO. In this case, the trader waited for a sideways quiet channel to occur. Sideways because the mean is sideways, quiet because the Bollinger Bands are pinched, channel because price and both regression lines are well inside the river, and then played the breakout above the river here with a stop here. He adjusts the stop and follows it up, and then when we get the RLCO on the far side, he exits here for 1.7R in about a half an hour. Here's a case of another RLCO pattern here. In this case, he front runs it looking really for an ARLS, but then let it convert into an RLCO trade, makes his entry here, with a 50-cent stop. Exits at the far side of the river, and shortly thereafter we just noticed that this one, failure to make new highs, back into the river and beginning to fail. This would not surprise us. To get short here would be successful after a failure at the far side of the river, given that the longer term trend is down. Here's one that uses Forex with a sideways quiet channel on 15-minute charts from Chris, one of our friends in Europe, a professional trader. And he's noted the sideways quiet channel, then a breakdown out of the dragon, and he makes his entry here, covers down here at the far side of the floodplain where it failed to fail further, and now he's able to lock in a pretty quick trade here. His first trade was here, a breakout, which then failed here for a minus 0.5R. He was looking for the sideways quiet channel breakout to the upside. When it failed, he stopped and reversed, and then turned that into a 2R trade for a net of 1.5R in the normal way, and we find the 15-minute charts working pretty well in the Forex pairs with this strategy. Here's a case of we have a move up, a breakdown out of the river. Price finds support. He buys the re-entry to the floodplain, and with a logical exit in here. May have been a little early, but his tight stop had 2R in hand, and it was approaching the Bollinger Band main, and so he was content to have that. You'll recognize some other patterns in here. RLCOs outside the river, breakdowns out of the river, a breakdown of support is a good trade. Breakouts out of sideways quiet channel can be rewarding. A lazy W pattern to re-enter. Here's another typical entry after an RLCO or ARLS entry at the edge of the river somewhere in here, and in this case he was able to cash at the far side with quite a move, and it's almost 2.5R. This is a trade on January 3 from TNA. So in the chat room, when we look in the closed trade journal, we want to see what the case studies are about. Regression line crossover on January 3rd, 2014, TNA. Here's a case of converting a swing trade to an intraday trade for improved exits. The trader was trading Tesla, had made some entries on sideways quiet channels, held a portion overnight. The next day there was range expansion, and then used the RLCO framework to time exits that were very powerful, very effective, and in this way combined swing trading and intraday trading with great success. This is one where we were taking a look at daily charts and trying to see how we might use regression lines and definitions to help us build some longer-term position trading for some long-term money managers. In this case, we're looking at daily bars. In this case, it's Anadarko Petroleum, and we were looking to find ways to code this pattern that we really like, and that is a long-term powerful uptrend which has a sharp sell-off and then features a consolidation zone that's starting to improve. So we're looking at the slope of the 10-day regression line starting to move back up, a steep down 30-period regression line on days -10 to -40, and then from day -41 to day -131, a 90-period regression line slope that's steeply up, sharp 30-day sell-off, 10 days of consolidation, and now getting ready to play breakouts and a reversion back to the long-term mean, or at least a 50% retracement. So this is a case where we think that Anadarko is finding that kind of a pattern. When you combine it with the long bottoming tail, we feel really good about this as a support level. That's a case of how we can start going from a basic idea that we want to trade and start turning it into codable definitions in order to build screens. This is one where we have a quick hit in the morning on VXX. The previous day had been in a sideways quiet channel on 5-minute charts. It opened up sharply down, well outside the floodplain, begins to move back up, almost an Anderson regression line stretch case here. The trader makes a entry at 41.53 with a 13-cent stop, and then within about 15 minutes is rewarded for 2 Rs on a quick hit, and that's just from edge of the floodplain to the edge of the floodplain. So trading inside this sideways channel, but taking advantage of the opportunity to recognize extreme conditions that are correcting themselves. Here's another one in SPY later that day that is sell off from the highs, makes an RLCO outside the river. He enters when it returns back into the river with a stop below the extreme low of the day, and then collects 0.6R on a simple move to the far side of the river, perfectly executed and a sound strategy inside the futures that can be traded as well. Here's one with a very tight stop, and it's inside. It's a $4 stop inside Google. We have an RLCO outside the river, makes the entry at the edge of the river, sells half after it leaves the river and is halfway through the floodplain and starts to collapse, cashes half, holds the other half, and then on failure to follow through is able to get a slightly better price improvement on the second half, and makes a nice trade for about, looks like 2R, and this is on 10-minute charts. This is the same pattern we saw before with Tesla, that had the entries the previous day and then a couple exits. These are also some possibilities for entries in here. On failure to fail back to the mean, there's also room inside here to either get long or to reinforce the core position with a turbo trade. Here's a case where we have a long-term trend up, a pullback that finds support at the edge of the river, and then on failure to fail further with a low and a higher low, the trader buys a core position here at 31.50 with a 50-cent stop, buys a second position turbo with a 20-cent stop, so now he's got a much larger position on evidence of improvement, and what he's hoping for is that if it breaks above the daily high that it's going to keep going. It actually does. He adds a second turbo position here at 31.75 with a 0.2 stop, and then is able exits the entire thing upon failure to follow through when price comes back into the dragon, and is willing to exit, and scratches the third trade, gets 1R on the second trade and 0.6R on the first trade due to the wider stops. And then this is just an ordinary follow through, gap down, morning hook, higher lows, and then using the framework to decide when to get out. A sideways quiet channel breakout in December on TNA, 2 higher lows, buys the sideways quiet channel breakout here, timely trade, range expansion, the 10 period is rolling over, price leaves the extremes, comes into the floodplain, buys or exits the position here as it leaves, or as it looks like it's getting to the edge of the dragon, halfway through the floodplain, and cashes 3.5R in a matter of about, looks like about 40 minutes. Now after that trade, the trade comes back, finds support, and now what the trader is looking at is the long-term slope is up. Here's the river, here's the floodplain. This is plus or minus 3 Bollinger Bands, just to calibrate. This is the price target at the previous swing high and the intraday high. And what the trader is betting on initially is that this long-term trend is going to happen, and if he can play this trade and then it gets to the intraday high and breaks through, it'll really take off. And meanwhile, he's going to use a wide stop, with the idea being stop and reverse at 34.82, adding a second position at 34.76 if the previous two intraday lows don't hold. So he's betting on the longer term trend to continue to follow through, and that the day is going to finish higher. It comes up, finds resistance where it found resistance before. The pullback to the Bollinger Band mean holds, and now we get a sideways quiet channel breakout. The trader waits, it doesn't add here, but waits for it to clear the previous swing high, makes the second entry here, sees the RLCO happen outside the river here, and exits both positions in a routine way at 1.5R. And this, the final trade here, of that particular sequence. That previous one we just looked at was conducted inside here for 1.5R, and now here's the trader sees a pullback. It finds support above the Bollinger Band mean, and actually acts like a bottoming tail. So now we have a 1, 2, 3 re-entry, and that is makes a swing low higher than the Bollinger Band mean after a successfully cashed trade. A second candle has a higher low, and when that closes with a higher low, the third candle is live when it takes out the previous candle's high. We're long with the stop here below the Bollinger Band mean. It moves up in an orderly fashion with a 20-cent stop. That's this trade here. It moves up. The exit is taken when price had gotten outside the floodplain, pulls back, he exits at in the middle of the dragon in this case, plots a re-entry because now it comes back, finds support in the river, and now a 1, 2, 3 re-entry, long again at 35.55. So there was a 3, it had gotten out at 58, re-entered at 55, and now we've got a nice long move going towards the close. Again, 20-cent stop, managed carefully, and then in order to get flat before the weekend, cashes at 35.82 for 1.3R on this leg and 0.6R in this leg. So when you take the original 1.5 and another 1.9, you're looking at 3.5R, trading in a routine, measured, risk-adjusted way all the way through the day. So those are some quick case studies that come from the trading of the last couple weeks from the chat room. And the important point I want to make here is that these are discussions and trades that are being conducted inside the chat room with traders talking each other through what they're seeing, what they're feeling, what they're doing, reflecting on the learning, helping each other see different parts of the pattern, refining our understandings, and through the combination of experiential learning, presentational learning, and practical learning, we are continuing to build evidence that will support our propositional knowledge, which is when we get into formal study, research, and reflection, and reducing these experiences into rules that can be back-tested. So we are clearly in the experiential learning mode here, and the practical learning mode, and the presentational learning mode as a way to build our inductive knowledge. So hopefully you find these instructive and helpful, and we look forward to working with you if these kinds of trades resonate with you, and if being a participant in a collaborative, non-judgmental, supportive learning environment appeals to you, then we'd be delighted to have you join us and help us grow together in knowledge. So this is Ken Law from Cordis Capital. Keep your risk measured and your powder dry.